Hi guys, so today we are here to discuss one of the most important concept, that is consolidation. Consolidation is the reason for the accounts that has been blown out, and it is one of the most deadly thing you can encounter in your trading. And I would be taking you some of the concept of the consolidation, and I would be telling you some of the secrets that you can understand that why this is happening, and then I would be also telling you that how you can save yourself from this deadly disease that is out there in the trading. So taking back to you to the demonstration first, guys, like this is a form of a consolidation that we usually see in the market. And consolidation happens because of a reason that the buyers and sellers, they agree on a certain price, right? Like for example, like a seller is saying that I would be selling these oranges for $1, and the buyer is saying, yeah, I would be accepting that, and see the price stays neutral. So guys, you need to understand that why this actually happens is the buyers and sellers are both agreeing on a certain price, right? And there isn't much spice there, like there isn't much volume there, or there isn't much supply, or there isn't much demand for that product, right? So the price goes the sideways, right? For example, like if there is a certain product and the demand and supply of that product isn't there much, right? And so of course the thing would be going on the sideway direction, right? So if there is demand, of course that price would be breaking on the upside, while if there is like more supply of this thing, right, so the price would be pushed on the downside, right? So it's the simple concept of the economic, that is the supply and demand, that you can feel it in this consolidation, that there isn't much of the buyers or sellers present in the market right away. I want you to understand the secret behind it is that how you can save yourself from this consolidation is only through working into the volatile periods of the market, right? So what are the volatile periods of the market is like the session openings, like the first hour of the sessions, right? And then the middle hour of the session, and that's only the most volatile time. And most people recommend you to work based on like the London and New York overlap. So as you can see here in the charts, I have highlighted certain types of consolidations. Like for example, there was like a big sell-off here, right? And then the price started pushing on the upper side, right? So guys, forming this type of structure and expecting this structure to go back up there without any kind of fight between buyers or sellers is not what a trader would be doing, right? So the idea behind it is that the price cannot be pushed on the upper side directly with the v-shaped structure unless and until there is an enough kind of volume or some kind of like a spicy news that is coming out, right? Like for example, consumer confidence, or something like job openings, unemployment, inflation, GDP, or there are like other kind of like PMIs and retail sales, and even leading to NFP. So without that kind of market behavior, you can't even expect a v-shaped structure like that happening, right? So in order for price to change the direction, price has to go to the sideways, in which there would be some kind of negotiation, right? So you need to work in the high volatile times in order to say to put you to the protections, right? So coming back to the price actions here, right, the price came back down, price went up, price came back down, right? And what really ended up happening, that price actually broke out of this structure, right? And you can see the close of this candle, right, this engulfing candle, the close of engulfing candle is on the upper side of all the wicks, right? And from here we can see the price was pushed on the upper side. Similarly, when you can see that the price was pushed on the upper side, then the price had to go to the sideways, right? Because they had to negotiate on the certain price, right? And there wasn't enough buyers that were coming along with that. So what really ended up happening, that you just had a discount, right? So you can see that as the price closed, and with the body that is lower to the wicks of the other candles, right? And then there was a sell off, right? And then there was again like a stop out hunt, and then the price went going into the same direction towards the downside, right? So you could have like grabbed that as well, right? So there is another kind of consolidation which we see, that is a continuation pattern, right? The buyers are being forced to go up, right? The price is pushed on the upper side, sellers, each time the sellers are like the sellers tried to come here, they were stopped out with this engulfing. Then there was like sellers again coming back, but this candle couldn't even like form a complete structure, and the buyers even took over. And this candle is an engulfing without even a wick, right, representing an intense volume in the market. And again, the price went back into the consolidation at that point, right? So when the price went into the consolidation, we can't see the exact breakout here, because you can see like the price is closing, prices, the way the price is closing, there is no wick on the downside, right? Or there is no candle that has been closed on the downside. So expecting it as a bullish consolidation, right? So the price broke out on the upper side, right? So guys, similarly, there is an last price action which I want to tell you that, as you can see, this is an intense consolidation, right? And there was like a close down there with the body closing underneath all the wicks, and then there was a big sell off, right? And then again the price went back and retested this level, right? And as the price retested, the price was pushed on the further downside. So guys, considering that this level was so important, that the price came back to this, and again the sellers were induced at this point, right? So so guys, let's understand this in this diagram, what really happening, that when the price was going and breaking on the upper side, right? So there was enough negotiation that was happening between the buyers and sellers, right? And there wasn't enough of the idea that uh, the much of the buyers weren't even coming, right? And as the buyers weren't coming, there was like a sell off that shows the strength of the sellers being induced in here, because the price owner started giving the discount, because the people weren't even buying on this level, right? And when the people weren't buying on these levels, so the discount started coming, right? The sellers, the supply side started increasing, because nobody was buying the product. So in that regard, when the price came back down, there was an intense buying that happened here, just because that the buyers suddenly got interested, and again the price went up to that same level where the where nobody was actually buying, and again the price started going back on the downside. So guys, these are the types of like the consolidations that we regularly monitor into the market. And the idea is to work only on the volatile times, right? If you are like sitting at the odd time opening your charts based on, while missing the initial session hours, and if you're expecting the price to break on the certain direction, it wouldn't be happening like that. So you need to be like super sure that what is your timing. So there are like three things that are really important in the market. Number one, timing. Number two, levels. And number three, behavior of the price. So take care, guys.